What do you think will be the Tesla stock price by the end of the decade? Even analysts and experts are at odds on their valuations for the leading EV company in the coming years. Tesla stock has been extremely volatile in the recent months, which made it hard for experts to predict the company's stock price. Gary Black dropped his own prediction, so you definitely would not want to miss this one. My 2030 Tesla EPS forecast is $120, Gary Black said in a previous tweet. Gary Black is the managing partner and co-founder of The Future Fund LLC, an SEC-registered investment advisor focused on investing in growth equities in companies that are changing the world. Gary has extensive experience spanning nearly 30 years in top management positions at some of the most well-respected global investment management firms. As CEO of Aegon Asset Management, he oversaw $120 billion in assets, representing a third of Aegon's assets and 50% of its profits. During his tenure, he created new proprietary investment strategies, expanded the real assets platform, leveraged the company's solution-based offerings, and directed the build-out of an ESG fixed income platform. Gary has been featured in Barron's and is frequently called upon by the financial press for his insights into the equity markets. In a July tweet, Black said, "My 2030 Tesla EPS forecast is $120. I attach a 2030 PE of 30x consistent with 15% vol and earnings growth from 2030 on. That's equal to a 2030 PT of $3,600. Discounting that back at 13.1% assumes a 3.5% 10-year TY to the present equals $1,400. At the time, Tesla stock was trading at around $232 per share. However, note that this prediction was made before Tesla split its stock in August. Still, it makes sense, as the EV company's stock is trading almost at the same level today as it did then, although it is considerably lower from $232 in July, as it is currently trading below $200. Black believes that Tesla stock is too cheap and that it should start buying back its own shares. Tesla bull and institutional investor Gary Black has said it is the right time for the company to perform a buyback, as its price-to-earnings ratio is the lowest it's been since COVID. Black sent a letter to the Tesla board of directors with a recommendation on how to spend some of the company's growing cash hoard. He wants them to buy back Tesla stock, as share buybacks can boost any stock. After all, a company is just another buyer of shares, and when there are more buyers than sellers, stock prices rise. In October, Gary Black and David Callis, co-founders of the Future Fund, in which Tesla is the single biggest holding, wrote an open letter to the Tesla board suggesting a $10 billion share buyback. Our view is that Tesla is now operating from a position of outstanding financial strength. With $18.9 billion in cash and marketable securities and virtually no debt, we believe now is a unique opportunity to buy your stock. Black urged the board to consider an aggressive multi-year stock buyback for at least $10 billion. We believe now is a unique opportunity to buy your stock at well below our estimate of $550 a share intrinsic value, the fund manager told the board. When short-term noise is depressing shares, as is happening now, Tesla management can buy back more shares. He added, "The pace of buyback can be slowed when the stock price rises," Black said, adding that most big techs, including Apple, Alphabet Inc., and Microsoft Corporation, have employed this buyback strategy consistently for years. Following the latest tweet, Black continued, "Remember, there are only 5 outlets for excess cash flow: pay down debt, acquisitions, dividends, share repurchases, and build up cash. Share repos likely offer the highest ROI of the 5. The fund manager also said the buybacks will unlikely have any impact on the company's financial flexibility. Buybacks may be preferred to dividends by Tesla shareholders, as this shareholder return policy has a favorable long-term capital gains tax treatment," he said. From the company's perspective, buybacks can be managed opportunistically, unlike dividends that are fairly rigid once put in place, Black said. Black's actively managed Future Fund Active has Tesla as its top holding, with the EV maker's stock accounting for close to 11% of its portfolio as of mid-October. When Tesla's third-quarter delivery shortfall early in October raised concerns about the demand, that led to a sell-off in shares. Black took to Twitter on Sunday to offer his take on whether the worries are well-founded. While Tesla Uber bulls blamed the shortfall on logistics issues, the reason for the miss was demand drying up in China at the end of the third quarter, the fund manager said. Chinese buyers were apparently waiting for a price cut that never materialized, he said. According to Black, deliveries in the fourth quarter may be under pressure if Chinese consumers continue to put off purchases until there is a price cut. Black has also been tweeting in recent weeks that concerns about Twitter are a headache for Tesla investors. In one tweet, Black said there are several problems for Tesla due to Twitter. One of them is the overhang from an eventual Tesla stock sale by Musk to finance the deal, and the distraction for Musk, especially since Elon's core competency is engineering and tech, and Twitter is more of an ad-driven media business. Tesla also has no chief operating officer. That means Musk has to take a hands-on approach at Tesla while also being distracted by his numerous other pursuits, such as SpaceX, The Boring Company, Neuralink, and potentially Twitter. The underwhelming deliveries and production numbers also underscore how a slowing global economy and possible recession could hurt Tesla. Other analysts, like Wedbush's Dan Ives, said his firm remains bullish on Tesla, but the overhang from the Twitter deal still remains. There is the potential that Musk may need to sell more stock to secure financing for the Twitter deal, which leaves uncertainty for some investors. Additionally, Ives' concerns regarding Tesla's brand deterioration still remain, and the CEO's evident focus on Twitter leaves Tesla in a difficult spot moving forward. Ives maintained a $250 price target and an outperform rating on Tesla stock. In a tweet, Ives noted, "The Twitter overhang is comprised of three main factors. 1. Fear of Musk selling more stock to fund Twitter's red ink. 2. Brand deterioration of Musk associated with Tesla. 3. Attention of Musk for now, all focused on Twitter instead of Tesla." Still, the analyst reiterated that they remain steadfastly bullish on the Tesla EV growth thesis over the next few years, but as discussed over the last few weeks, recognized that until this Twitter dark cloud passes, it will remain an overhang on Tesla, said Ives in another tweet. Also, Citigroup analyst Itay Michaeli upgraded his outlook on Tesla shares to a neutral rating despite holding a bearish forecast for several years. In a note to investors, Michaeli shared, "To be sure, macro-competitive concerns are likely to remain an overhang with capacity rising. But as we've previously written, in a hard landing scenario, Tesla's long-term competitive position likely also improves and potentially further enhanced," referring to President Joe Biden's Inflation Reduction Act. Tesla stock is now trading at its lowest PE ratio since COVID-19 at 37 times the estimated earnings per share for 2022, Black noted. This is despite the company's operating from a position of outstanding financial strength, he added. Tesla had $18.9 billion in cash and marketable securities and debt as of June 30, 2022, and is on track to generate a free cash flow of $20 billion after deducting all capital expenditure in 2023, he added. In a November 29th tweet, Black shared what could be the biggest near-term Tesla catalyst. The biggest near-term Tesla catalyst could be the new 7500 EV credit that goes into effect in the US on January 1, 2023 under IRA. We estimate the $7,500 rebate could boost US deliveries from 520,000 in fiscal year 2022 to 840,000 in fiscal year 23, supported by an Austin production ramp from 40K in fiscal year 22 to 280K in fiscal year 23. According to the Future Fund managing partner and co-founder Gary Black, Tesla's market capitalization could reach as high as $4 trillion by 2030. Black says the EV industry will reach 60% market penetration by 2030, and he anticipates Tesla will achieve a whopping 21% of the auto market share. On Twitter, Black wrote, "When EV adoption hits 60%, Tesla with 20% EV share will be viewed as a safe haven like Apple." Today, whether Tesla stock will be $120 by 2030, as Black predicted, remains to be seen. Numerous factors may affect a company's stock, and Tesla is facing several of them now, with Musk's Twitter takeover as well as the threat of a recession. Economic factors, most of all, can either bring great advantages or huge detriments to a company's progress. Subscribe to this channel to see more Tesla stock price predictions.